Welcome to the video, where we show you how to stop wasting money on high-interest car loans by refinancing the smart way. In this guide, we will explain how auto loan refinancing works, why the loan-to-value ratio matters, how to shop for the best rates, and what pitfalls to avoid. We will also walk through a practical step-by-step plan and show saving scenarios so you can act confidently. Let's begin. Here is the roadmap for today's session. First, we will define refinancing and explain how the process works. Next, we will uncover the hidden trap many people miss, the loan-to-value ratio. Then, we will go step by step through a refinance checklist so you can execute with confidence. After that, we will compare banks and credit unions to help you decide where to shop. We will then look at real savings scenarios. Finally, throughout the video, we will include short quizzes to help you confirm your understanding. To begin, high interest rates on auto loans are like financial poison because they siphon money from your budget into interest rather than equity. Refinancing replaces your current high-interest loan with a new one at a lower rate and better terms. If you have made on-time payments for at least 12 months and your credit profile has improved, you are in a strong position to refinance. As we transition to the mechanics, remember that the goal is to reduce interest costs, improve cash flow, and own your vehicle sooner. Here is how auto refinancing works from start to finish. First, you apply with a new lender. This is often a credit union, though national and regional banks can also be competitive. Next, if approved, the new lender funds the payoff directly to your old lender. Your old loan account is closed as soon as the payoff posts. Finally, you begin making payments to the new lender under the new terms, which typically include a lower interest rate and sometimes a different repayment period. Importantly, the process is designed to be seamless for you. You do not receive the money. The payoff is lender to lender. This prevents delays and ensures your old loan is fully settled. Now that you understand the mechanics, we will move on to the key risk many borrowers overlook: the loan-to-value ratio. Next, let's talk about the loan-to-value ratio, or LTV. LTV compares how much you owe on your car to the vehicle's current market value. It is calculated as the loan balance divided by the car's value. Because vehicles depreciate quickly, it is common for the LTV to creep higher, especially when interest rates are high and more of your early payments go to interest rather than principal. Lenders are wary of high LTVs because they view them as riskier. If your LTV is above a lender's threshold, your application may be declined even if you have on-time payments. To reduce your LTV, consider paying extra toward principal before applying, making a small cash contribution at refinance to lower the balance, or improving your credit score to justify the lender's risk. You can also consider a slightly longer term to reduce payment shock, but be cautious because stretching the term increases total interest over time. Because depreciation continues month after month, it is smart to act quickly once your credit improves and your payment history is strong. Moving forward, here is a practical checklist to follow. First, check your credit score and your full credit reports to ensure accuracy and identify areas for quick improvements. Second, gather essential documents including recent pay stubs, proof of insurance, vehicle registration, and your current loan statement. Third, estimate your vehicle's market value using multiple sources such as Kelley Blue Book and Edmunds to get a realistic LTV. Fourth, shop aggressively across lenders, credit unions, national banks, and regional banks. Seek multiple pre-approvals to benchmark rates. Fifth, review your current loan contract for any prepayment penalties. While rare, they do exist and can erode your savings. Sixth, compare offers on more than just the monthly payment. Focus on APR, length of term, lender fees, and total interest paid over the life of the loan. Seventh, when you choose a lender, coordinate the payoff timing so the amount sent to your old lender matches your latest payoff quote. Finally, confirm your old account is closed once paid and set auto pay with your new lender to protect your credit history. Additionally, before applying, prepare with a simple readiness checklist. Reduce credit card utilization below 30% if possible. Dispute any clear credit report errors and ensure your on-time payment streak is intact. Make 1 or 2 extra principal payments if needed to lower your LTV. Collect at least 3 competing offers to strengthen your negotiating position. Verify there is no prepayment penalty in your original loan contract. Finally, target a refinance date within the next 30 days so depreciation does not work against you. Now let's compare banks and credit unions. Banks typically have strong online platforms and fast approvals, and they may run promotional rates. However, they can be more rigid on loan-to-value thresholds and often quote slightly higher refinance rates than credit unions. On the other hand, credit unions frequently deliver the most competitive rates and member-oriented underwriting. They may be more flexible about borderline LTVs, consider relationship factors, and sometimes reduce or waive certain fees. If your priority is the lowest possible APR, credit unions should be high on your shopping list, though it is still wise to request quotes from both banks and credit unions to compare apples to apples. To bring this to life, consider 3 simplified scenarios. In the first, the borrower drops from 11.5% to 6%, with 48 months remaining on an $18,000 balance, yielding a payment around $422 and saving roughly $2,300 to $2,800 in interest, depending on exact fees and timing. In the second, the borrower moves from 9.9% to 5.2% over 36 months, with a $14,000 balance, producing an estimated $421 payment and savings around $1,400 to $1,900. In the third, the borrower moves from 13% to 6.9% over 60 months, with a $22,000 balance, seeing a payment near $435 and saving around $3,200 to $3,900. These are illustrative only. Always request a full amortization from your lender to verify your exact savings. Here is a simple 30-day refinance plan. In week 1, check your credit, gather your documents, and estimate your vehicle's market value to calculate your LTV. In week 2, aggressively shop lenders and secure pre-approvals so you can compare rates and fees with real numbers. In week 3, apply with your top choice, lock your rate if offered, and request an up-to-date payoff quote from your current lender. In week 4, the new lender funds the payoff, you verify the old loan is closed, and you set up autopay with the new lender. This timeline helps you act before depreciation worsens your LTV. This sequence diagram will depict the interaction flow among the borrower, multiple prospective lenders, and the old lender. It begins with the borrower requesting quotes from a bank, a regional bank, and a credit union at the same time. Each institution returns an offer that specifies APR and term. The borrower selects the best offer, in this example the credit union, and submits a complete application with documents. The credit union conducts underwriting, including a check of the borrower's LTV and any prepayment penalty in the original contract. Upon approval, the credit union issues the payoff amount and funds payment to the old lender. The old lender confirms the loan is closed. The borrower then starts making payments to the credit union under the new terms. This diagram emphasizes parallel shopping, underwriting checks, and the lender-to-lender payoff. Quiz time. If your car's value is $12,000 and your loan balance is $14,400, what is your LTV? And why might that be a problem for refinancing? Option A, LTV equals 86%, usually fine for any lender. Option B, LTV equals 100%, borderline but acceptable. Option C, LTV equals 120%, many lenders may decline. Option D, LTV equals 60%, extremely safe. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is LTV equals 120%. Many lenders may decline. The calculation is 14,400 divided by 12,000, which equals 1.2 or 120%. This means you owe more than the vehicle's market value. Many lenders will see this as elevated risk and may either decline the application or require cash at closing, an improved credit profile, or other compensating factors. Second quiz. Which step can erase your refinancing savings if you overlook it? Option A, comparing at least 3 offers. Option B, checking for prepayment penalties in your current loan. Option C, requesting a current payoff quote. Option D, setting up autopay with the new lender. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is checking for prepayment penalties in your current loan. While many auto loans do not include these anymore, some still do. If you pay off the old loan early and a penalty applies, it can erase much of your interest savings. Always review your original contract before you apply to refinance. Before we wrap up, a quick disclaimer. This content is for educational purposes only and does not constitute financial advice. Your rates, approval odds, and terms will vary by lender, region, vehicle condition, mileage, and your credit profile. Additionally, refinance applications typically involve hard credit inquiries that may impact your credit score. Please consult your lender or a qualified financial professional for advice specific to your situation. Here are the essential takeaways. Shop aggressively and never accept the first offer. Prioritize credit unions because they often provide the most competitive refinance rates. And confirm whether your original loan contains a prepayment penalty before applying. Act promptly to beat vehicle depreciation, which can push your LTV higher and reduce your approval odds. Finally, compare offers based on total interest and fees, not just the monthly payment. To summarize, refinancing allows you to replace your high-interest auto loan with a lower-rate loan, reducing interest and often your monthly payment. Keep a close eye on your loan-to-value ratio and consider lowering your balance or improving your credit to strengthen your application. Follow a simple 30-day plan. Prepare, shop, apply, and confirm your old loan closure. While credit unions frequently provide the best rates, gathering multiple quotes ensures you obtain the strongest offer available. Thank you for watching. If you found this helpful, please like the video, share it with someone who might be overpaying on their car loan, and subscribe for more strategies to save money. Share your refinance plans and questions in the comments so the community can learn together.